It is a basket. So basically, someone will come and so eventually you will be what he gave example of a cheese maker or hamburger. He said if you eat hamburger, when you will be when the price is higher, price is low. Why low? He said you are buying stock. Why you are putting in the stock market? You should put the stock market low. And why low? He says you should buy when the stock market is
Good afternoon, everyone. Thanks for joining us today. I hope we don't have too many more guests because there's just 3 chairs left, 4 or 5. Right. So today is our 17th meetup for the Bogleheads group and Common Sense Personal Finance and Investing. Today, Brahim, one of our group members, is going to share his experience on the basics of investing and basically tell you a bit about his story and how he got to learn to invest as a Boglehead and how that compares with some other approaches that he's explored. But before we start, I'd like to ask for whom it is the first time joining us for one of the meetups. Right, so I always ask the question just to know whether I should go through the introduction or not. So today I'll go through the introduction, make sure that everybody knows what we do and who we are and how you can connect with us. There is a sign-up sheet that is, I think, going around. Does anybody have it? Yeah, if you don't mind circulating that, we use it only for our mailing list. We send newsletters maybe once a month with just the upcoming meetups. So that's in addition to the Facebook group and the meetup page that we maintain. Right, before we start, a disclaimer: we are not professional financial advisors. We are here to share our knowledge, to learn from other people's experience, and to really have a discussion about money. Something that is important, but that we don't talk about enough because in many cases it's considered a bit taboo. This group has been set up just to facilitate that discussion, and you're all welcome to participate, share your knowledge. But really, the most important part is that you need to do your own research. You are responsible in the end for your money, no one else is. And so do your research and make the decisions based on your understanding. In the end, you can't sue us because we're not even, well, there's nothing you can get from us. We're just doing this to help. Right, it's your responsibility to learn and manage your own finance. Today, Brahim, as I was saying, will share his story. Brahim is not a financial advisor. He's a consultant in new media and technology. And he's been traveling the world, and he's been now in Dubai for 10 years. Because of his history of being Moroccan and studying in more expensive places, he's always been very aware about expenses and money in general. And so very early on, he started looking at investment and how to save for retirement. So he's done a lot of work in that area, and today he's here to share that with us. In general, this is what we do in the group. We talk about different topics, and today we'll mostly talk about one aspect of investment. The group is here to help you and help me do this, right? So we start by saving, we plan for investment in our future, we learn to invest, we actually do invest, so we put those things into action. We learn to stay the course, which is pretty important in the Bogleheads philosophy, and finally, we all want to enjoy financial freedom. So we also talk about financial freedom, one of the aspects of our discussions. A little bit of wisdom. Investing is simple but not easy. It's a very important quote from Warren Buffett because a lot of people think that this is not true, right? Why does the majority of people not invest directly? Is because they think investing is complex, or that they need a lot of complicated products or expensive advisors to help them do that. So investing is fairly simple. Today, Brahim will tell us really some of the basics, and you see it's not that complicated. And once you've read a few books, you will understand that this is pretty straightforward. What's difficult is sometimes the actual implementation. So we say it's not easy because there is always a temptation to try to time the market, make quick gains, etc. The philosophy that we teach is a very simple philosophy where we look at long-term market returns. It's simple to implement. It doesn't require much work. So once it's set up, it should take you 5 to 15 minutes every month, maximum, I would say. So it's not an active approach, and it's fairly straightforward. Now, there's two ways of implementing, and in this group we support both ways. The first way is you learn everything about personal finance and investing, and today we're going to start with that. And then you do it on your own. So you actually open a brokerage account, you find ETFs that are relevant for you, and then you start investing according to your own investment strategy. The other approach is you learn and you understand how this stuff works, and then you get unbiased help. So you get an advisor, someone that will help you achieve your own goals without being biased by its own interest. This is a bit of a warning because outside of a lot of regulated countries, advisors don't always do work for you, but rather they work for themselves. Topic of another discussion. So yeah, in general, we are a non-profit community of personal finance enthusiasts, and we're here to share. We started officially the group more than a year ago. That was the first meetup we had. And we're also the official chapters of the Bogleheads, which is an organization that helps people understand simple way of investing. This is our team today, but it's a team that's been changing over time. We are open to more people joining us to help and organize these kind of meetups, to share knowledge and help raise awareness for everyone. So myself, Marwa Barota, Tuni, who's also here, and Jen, who's currently in the US. Right, we're looking for more people to join the team, so let us know if you're interested to help organizing meetups like this, finding speakers or even speaking yourself. Feel free to come to me or one of the members. These are all the different topics all the meetups that we've organized in the past year. I'm not going to go into details, but we basically covered all aspects of investment, as you've seen with this initial arrow at the beginning. And the last one we had was with Andrew Hallam a couple of weeks ago. We have a website where we maintain a calendar with the upcoming meetups, and these are the two meetups that are already there and scheduled. So next week we have a talk on real estate, and Andrew and Heidi, who are group members, will share their own experience on how they've purchased property in the UK from here, and all the challenges that they've encountered, and they will share a lot of the good lessons there. And then 2 weeks later, I'll be speaking on how I track my personal finance and how I forecast my own wealth. Right. That's all done with the Excel file, which will be shared as well. So feel free to join for those two. And finally, we have, we also share summaries of our events on the blog. So you can always go back and see what we've talked about in the past. And these are two of the very famous ones. On the left, we have a summary of the brokers that are available to UAE expats. So Alex gave us a presentation last year, which was really good. It's quite interesting if you're already at that stage in your investment path where you're looking for a brokerage platform to do your first investments. And then this is a summary of the financial independence and early retirement talk we had in August. Finally, we have a Facebook group where there's a lot of interaction, so feel free to join us here too. As always, this is a good place for you to ask your personal questions and get support from the group. A lot of people are really helping one another there. That's it for the introduction. Now I'd like to welcome Brahim. Please join me in welcoming Brahim.
Good afternoon, everyone. Thank you for coming today to listen to what I have to say instead of going for a brunch. I know you guys took time from your long weekend, and I thank you for that. Before starting, I would like to know, I saw you guys, some of you are still new, who has a basic knowledge of finance? That's basic. Who has no idea? Okay, thank you. So today, what I try to do in this presentation is to mix it up a little bit, to talk to you about the very basic of what is a stock, what is a bond, what is a market exchange, but also I wanted to contrast a couple of different philosophies and styles and strategies in finance for those who are already versed into the subject. I would also like to open it up for discussion. I know it's not a monologue, so please feel free to chip in any information, or if you spot anything that's perhaps not correct, to comment on it. So my name is Brahim Laraiki. I am a digital media consultant. I love running. I just started yoga, and I live in Dubai since 2008. I was always a saver, and I was always conscious about it for a long time, but that's where it stopped for me, except for buying my own where I live. Few major events in 2015, 2016 prompted me to really start learning and taking care of my finance and investing. Then I met the Bogleheads last year, and one of the things that I like is financial markets and how they work. And I'm really, always in search for new information and new stuff in the field. But I'm not an expert. So we are not financial advisors. I am not a professor in financial markets, but I have some basic knowledge and I want to share it with you and discuss it. So today what we'll try to do is to understand the rationale behind the Bogleheads philosophy, and also we'll put it in perspective and contrast it with the other techniques and the other philosophies in personal finance and investing. And we'll also go through the securities and the vehicles that are available in passive investing, and the mechanics behind it and why they work, and also we'll recap with the principles of the Boglehead style of investing. So this is the table of contents. I'll tell you a little bit about myself and how I got into this stage. We will talk about what is a fundamental analysis versus technical analysis, theories that support the passive investing and diversification. We'll compare investing with trading, value versus growth, passive, active indexing, and we will go to talk a little bit about investment funds, ETFs, and some recommendations later. So you all know this. You have all watched this. This is basically my life before, the Boglehead and before getting into the financial independence journey. Lost meaning, as I said, I was saving. I wasn't like someone who is spending, someone who is looking to put order in his finance, but having all that money sitting in a bank account, knowing, basically knowing that it is losing value on a daily basis, that wasn't for me sort of being in the dark or lost. Lost also because I didn't make time to take care of my finances, to learn about finance. Then, as I said, Uh, I remember once, when I was a student, still in the university, reading a book. I cannot tell you what's the title of the book, or it's one of these books that you read and they stay always in the background of your head. You never forget about it. And 3 words I took from that book. It was work, save, and invest. And also, encouraged everyone, encouraged the readers to invest in the market, and made it easy for me to believe that it's not really complicated. So since then, as I said, hardcore saver, until I lost my job. When I lost my job, I went through a lot of emotions, a lot of problems in my life. But there was a moment of awareness where I said, now you have time to start putting order in your finances. Go and learn. And again, back to the books, and I started just Googling any courses, any resources to help me learn. And one of the things, and one of the courses I really loved, and I found, and it's free on internet, is the lecture of Robert Schiller on financial market. Now, this is not a practical course on how to invest. It's more so about history of financial markets, the mechanics behind it, the theories. It's fascinating, but it's long. It's, I think, 18 episodes of 1 hour and a half each. Take your time, and drink a lot of coffee while you are watching that, because you may sleep. So let's start by some simple definitions. We all know stocks and shares. I'm sure you guys have an idea of what it is. And but basically, a stock is an ownership in a company. It gives you the right to profit that company makes. It gives you also the right to vote in a big corporation for the decisions and decision makers in that organization. As I said, there is a lot to learn about stocks, technically speaking, so we are not going to do that. But let me tell you that stocks and stock markets are a very important part of the economy. It's not a casino. It's a mechanism by which our capitalist economies work. Companies, they don't have money, they will not work, and stock markets are there to provide the organizations and the companies with that lifeblood. Stock markets are made of buyers, sellers of securities, regulators, and intermediaries, brokers, etc. A company goes into the stock markets via the mechanism of initial public offering, IPO. So an IPO is when an organization goes for the first time into the stock market. So it's a major event for any organization who's going to be listed. We will get into the psychology of stock markets later, but the market is also impacted by price fluctuation of all securities, and there's a lot of human factor in determining the price of an organization. There are 2 ways that you can make money with stocks. One is by capital gains, so the price of a share fluctuates and appreciates or depreciates over time, so you can make money by selling that share, or you can lose money by when that share goes below the price you initially bought that share with. The second way you can make money is dividends, and it is the profits that organizations make and distribute it over their shareholders. The second security is bonds, and bonds is basically debt. So there are 2 ways an organization or a company can finance itself: is through financial markets, or by contracting debt. Third is self-financing, is when the company takes the profit and injects it back into the capital. Bonds, as I said, they are issued by governments, by companies, also by states, by municipalities to finance their projects and growth. When you buy a bond has a maturity, and what you get is an interest on that bond, and that interest is called a coupon. So that's it for the bond. We will again not go into details of how, and bonds can be bought and sold at the same time as well. So you can sell and buy bonds in the stock market. Now, we move on to a couple of philosophies and techniques in the stock market. So there are two ways organizations and financial experts determine the value of an organization. There is the fundamental analysis and the technical analysis. These are contrasting approaches to valuing a company. The fundamental analysis is the technique by which you financial experts seek to value a company through the intrinsic value of it. So basically they crunch the numbers, they look at the financial statements, they physically go and check the assets of the organization, and through that mechanism they determine the real value of that organization and its stock price. In contrast, the technical analysts are the ones who look into charts and patterns of similar organizations to value another organization. Basically, a technical analyst can sit down and just look into numbers in his laptop, versus the fundamental analyst who will look more into the business and the financial health of the organization. So there are two conflicting approaches, and right now we don't, before it was polarizing, there were two groups. Today we are looking more into a blend of these approaches, and there are fundamental analysts. Once they did the analysis, they also crunch the numbers and go through charts to verify their assumptions. Usually fundamental analysts are associated with long-term investing, and technical analysts are associated with short-term trading techniques. So some theories that back the Bogleheads philosophy is, one of them is the efficient market hypothesis. So the efficient market hypothesis basically states that markets are efficient. All the information is already included in the price, so you cannot beat the market. It's impossible to beat the market. The only way that you can invest is by working with the market, and basically through indexing and following an index. You cannot, there are no nuggets, gold nuggets in the market. There are no cheap stocks. So the price reflects all the information that has been already that's available, and it's a theory developed by Eugene Fama. The second theory is the modern portfolio theory, which deals with the risk versus the reward, and basically the modern portfolio theory try to optimize a diversified portfolio in order to reach a certain return. So you can see here, this is just an example of different types of securities ranked by the return they had every year. So you can see here small growth stocks in 2013 are the highest performing security class or investment asset class. And basically, if you want a certain kind of return, you wanna get into the right mix and in your portfolio of diverse asset classes. The two concepts that also are contrasting is investing versus trading. You all guys know the difference, I'm sure. But investing is basically, I see it myself as going and buying a business. When I buy a stock, I am buying a business, and I want that business to make profit. And I need to learn about it, and I need to be in that business for a long time. Trading is different. Trading is, for me, associated with casino. So is trying to buy and sell trade fast to make immediate and quick return. Here are some facts or fun facts about stock markets and investing. The oldest stock exchange is in Amsterdam. Was founded in 1602. The first crash, I don't know if you guys know this one, but it's quite a funny fact, was the crash of the tulip mania craze in Amsterdam. At that time, tulips were in fashion, imported from Istanbul, and some of the tulips reached the price of entire estates, 4 times the yearly wage of labor, which is crazy. Bombay Stock Exchange is has the highest number of listed companies, 5,000 plus. Usually September is the worst day in the year for investors, and that's because people are taking holidays, summer holidays. Yeah. And in 2008, 80% of the trading is done by algorithms. We are in the age where it is really hard to trade as a human being, so don't trade. Fast forward, after I started learning about personal finance, I decided to, as I said, to make orders in my own finances, so I started meeting every advisor in this city. Whoever has to offer something to help me with my finances, I gave them a shot. As you can imagine, not. Sorry?
It could not go well.
No, and it's funny because some would offer you club memberships, golf, stuff, and they would call you every day. They would take you for drinks and fancy places. But I had to do that because I needed to learn. It's a learning experience just to hear from them, and trust me, they give you really good information. Information that will help you. So that's an exercise that if you guys are looking to invest, do that. Just meet them. You will learn quite a bit.
Is it on a fee basis? Like when you meet those consultants?
No, they are very happy to meet you, to sell you the stuff. So it's for free.
It's for free until you buy.
Yeah.
But we know what not to do.
Exactly. Then I started going a bit technical, so I bought books. Actually, a few books. The book that really got me into this is Rich Dad Poor Dad. Very motivational. I find that book a little more from an investing perspective, not my thing, but from to keep you in the hype and warmed up. It's really cool. The Bogleheads guide for investing. Random walk down Wall Street. But funny enough, nothing to do with investing. I read the trilogy of Steve Larsen, Millennium. Did someone read? Yeah?
Yeah.
Nothing to do with finance, right? But what I liked in the book is Lisbeth. Lisbeth is the main character, and she's basically gained her own independence over time, including the financial independence. So I said, yeah, I can do it myself. I can become independent financially. So after the books, I read there is also an interesting course on personal finance 101 on YouTube. That's more so about how you organize your finances, how to cut on debt and expenses, how to calculate annuities, how to calculate it is very practical and it's really good. But my favorite by no means is the Morningstar Online Academy. It's a bit long, but it's extremely practical. And if you guys complete that course with a certain grade, because it gives you grades. There are a lot of tests. You get, I guess, 1 month or 2 months free subscription to Morningstar services, which is kind of nice. You are learning. Once you learn, you get to use those services if you are looking to invest. So once I went through all of that, options began to appear. So I went to the desert and had a wet towel on my head and lit lamp and what shall I do? But I had options that I didn't need a financial advisor. All I had to do is to just pick 2 or 3 securities and that's it. So that's the course I'm advising everyone to go to. It's very easy, very to the point, a bit old-fashioned, but really valuable. Now, other concepts, value versus growth investing. So the difference between, if you hear those 2 terms, value investing, I already explained, is looking at the real value of a company, an organization, a share. But value investing is looking for those underpriced securities, underpriced shares, and recognizing them, buying them, and holding them for the long term. Growth investing, in contrast, is when you are looking into organizations that have potential to grow, and doesn't, regardless of the price, whether it is undervalued or overvalued. The most important is to look for those shares that have potential for growth. Passive investing versus active investing. Passive investing is basically the approach of buying stocks, buying securities, and holding them for the long term. Recognizing that on a long term there will be growth. Active investing is the other approach is trading, is looking for to beat the market, is looking for those securities that or you speculate or you bet that they will appreciate. Indexing. So you all know what is an index. We all know the S&P 500, the FTSE, the Nikkei. These are the indices. An index. There are different ways of calculating an index, and we all know the 10,000 points of I think the S&P 500. But it's a statistical indicator of the growth of a stock exchange, a market. The way you should look at it, don't look at it from a points perspective, it doesn't tell us much if the Dow Jones is 3,000, 4,000 points up. But look at it from a percentage perspective, the growth, how many percent the Dow Jones went. So indexing is a strategy, is an investment strategy that strives to stick to an index. So if you buy, for example, a fund which is an index fund, that fund will buy a representative share of shares that constitute the index that it is following. So, for example, the VPI index in green here is investing in the stocks and securities that exist in equal proportions in the S&P 500, so the Vanguard 500 index. So you see, it tries to emulate it and as close as possible. Yes, so as I explained, this is the historical graph of the S&P 500, and its return over since inception is 10%. So those who invest in funds that emulates the S&P 500, they can expect an average of 10% if they invested since inception.
10% per year.
Per year, yes. So different vocabularies, for we saw the value versus growth, trading, investing. So you kind of now see that there are two philosophies, two mentalities in investing. Again, I was reading an article and it was about like the different vocabularies for the two different philosophies. So as you can see, in passive investing, we deal with simple stuff. Stocks, bonds, funds, dividend, portfolio, index. That's it. If you want to go the dangerous road, you can see how complicated it can be. So now we will move into some of the vehicles that you can use if you want to go down the passive investing road. And one of them is investment funds. So what is an investment fund? An investment fund is basically what it says. It's a fund that clubs the investments of many investors into one pocket and use the expertise of managers, of portfolio managers, to invest in diverse securities. So it's a simple way of taking that complexity out of investing for the investor. It comes at a fee, obviously. And we will talk about the fees, but the fees here are lower. There are mutual funds, the ones that I just described, but there are also ETFs, and they are pretty much in fashion right now. A lot of people are moving into ETFs. Some they say it's the future of investing. Some they even speculate that mutual funds will cease existing and ETFs will take over. So it's hard to tell the difference, to be honest. I try to find ways to explain what's the difference between a mutual fund and an exchange traded fund. The difference is in technicalities, but basically an ETF is traded on a daily basis, whereas and it's floating in the stock market, whereas the mutual fund you can only buy or sell it after working hours or after the closing of the day, and its value is calculated once a day, whereas an ETF it's like a stock, it's there, you can buy it and sell it anytime. The difference is also in fees, taxation, but these things, for me as a simple investor, I don't really see the difference. Actually, when I started investing, I wanted to buy mutual funds, but I found that I couldn't buy them through my broker, so I went for ETFs. Straight. And I, yeah.
So I think for those of you who read the Bogleheads book, the Bogleheads Guide to
they are, for me, they are simple, they are available, and they are cheap. And as I said, a lot of experts are talking about the future of investment mutual fund is in ETFs. That's
Excuse me. What are pros and cons of ETF versus index fund? Is there any pros and cons, or both are equivalent kind of?
For me, again, this is my opinion, and I'm not an expert in the matter. The difference is, again, it's more flexible.
I
it's
suggest
cheaper.
we keep the Q&A at the end, otherwise we get, sort of diverge.
Sure, but I will answer to your question. It's again, it's in fees. Taxation apparently is better from a tax perspective to be on ETFs than with mutual funds. And if you are looking, it's more liquid as well. So, but again, I don't see a major difference personally. So, and as Donald has said, they are not mutual funds are not available to us here as investors.
And ETFs are also, you can buy ETFs which are index funds. So when you ask for index funds, ETFs are also index, there are index ETFs.
Yeah. And there are sector ETFs, there are gold ETFs, regional ETFs. You have all sorts of ETFs. Okay. So these are look at it as two different columns. These are a typical holding of an ETF, for example. So the 25 top holdings of that ETF are made of, as you can see, energy. Obviously, it's an energy ETF made of energy stocks. Could be that the ETF could hold as little as 8 stocks, but it can go way beyond that, especially if it's trying to represent an index like S&P 500, so we might have tons of stocks inside.
Is this ETF the S&P 500?
No, I don't know. Sorry, both of them I don't know. I just picked a couple of pictures.
So
But you
just
can
a
see
random ETF.
Yeah,
that
random
you
ETF.
can
Or you can have, you see here, Microsoft, Apple, Procter and Gamble. Net asset value. This is also an important term to know. The price of a share is valued by its price. An ETF or a mutual fund is valued differently and is valued by what they call the NAV, and net asset value. It's basically total amount of that holding minus the liabilities divided by the shares of the fund itself. Now, one of the differences between mutual fund and ETFs, as I said, is that an ETF you can buy it and sell it during the day, and the price can marginally change a little bit from its NAV, its net asset value. So, but marginally, it always comes back to the net asset value. And the net asset value of mutual funds are calculated once a day after the market is closed. These are some recommendations, personal recommendations for picking your first fund. If you are going down the road of passive investment, Bogleheads style, seek always diversification. Never ever buy one type of asset. Diversify geographically, diversify in terms of assets themselves. The diversification is also a mentality, and once you get into that mentality, you start diversifying everything. Start diversifying your banks, your accounts, where you put your money. You become like a squirrel. You put things a little bit everywhere. Favor large companies. They tend to be the most profitable on the long run. Also go with big known families of funds such as Fidelity, Vanguard, T. Roy's, etc. There are BlackRock, all these families of funds. The reason we advise that is because they also have a discretionary way of managing funds. So if one manager goes, there is always a manager in that team of managers to follow and continue the same philosophy and the same strategy, and choose the index funds. They are the cheapest, they are the safest. They, again, as I said, they follow the markets day in, day out. And they're fairly predictable. I don't agree with that, but you know, it's, yeah, there is a certain degree of predictability there. Yes, yes. If you go through your broker, you will, yeah, in terms of ETFs, there is almost everything. No, I have my own. I will. I mean, through your broker, obviously. You don't buy directly from Vanguard, but you buy through your broker. Because Vanguard, they don't sell directly. How you could build your portfolio? Again, there are no right answers. Everyone has his own objectives, his own circumstances. So if you gotta define your objective, what are you trying to achieve? Are you trying to save and invest for retirement, or for your second house, or for your kids' school? Whatever that objective is, will determine the way you will shape that portfolio. It is irrelevant how many holdings you should have. One fund usually is enough. If it's diversified enough, if it is cheap, and if you want to keep it for the long run, right? It could be 2, 3, it could be as much as you want, but the most important is keep it simple and diversify. Should be diversified. That's, you know, I can't stress that enough. Consider your tax situation. We are all from different countries. We have all different tax collectors, so we need to consider that and look at that closely. Yeah, and the most important is do not panic. Yeah, just hold on to it. Even if whatever is the next crash. I know that a lot of people they are scared of crashes. You know, it's normal because they affect us. The media also overplays it. But crashes are nothing for a passive investor. It's just a mere accident in your path. Because as I showed you before, these are crashes, right? The 2009 crash, the dot-com crash. But guess what? It's 2017. There it is. The guy who sold here, bad luck. But if he held, this is where he would be now.
I'd like to add something.
Please.
So we've all heard about the crash in the 30s as well, right? The Great Depression.
No, it's not there.
It's not even there. It's not. But imagine it would have been probably a little drop smaller than that, right? We're looking at the very long term here. So things that happened in the past 40 years. So you want to drop here, right? So when you were investing here, you lost money here, say 25%. Does that really matter compared to where we are today? Right? We all, I mean, the way we work in this grouping, we invest for the future long term. The money that I'm investing today is going to stay in there 40 years, probably 60 years. I'm
just above 30, and I hope I will live until I'm 90. The money will be there and working for me for a very long time. So what happens in the next 5-10 years almost doesn't impact anything. It's going to keep going up. So say if I had started around here and I had been scared of a drop, right? I would have been trying to time the market, trying to buy low, sell high, do different things. When really what matters is put as much money as you can. It doesn't really matter whether you put it here, or here, or here, or here, or here. It's just put as much as you can and don't touch it, right? The plan is to let it grow. This is really scary because you lose a lot of money, but you've made so much money on the way that then that happens, you okay, you continue, and then it keeps going, right? So when we look at things long term, those small blips up and down, they might be scary, it's going to be in the newspaper everywhere. The truth is, it's a temporary downturn, right? So this is why we say that it's simple but not easy, is because we all have a massive fear of loss. So when this happens, everybody hurts inside massively, right? The problem is if you start selling and if you think that you can be smarter than all the other investors, then most of the time that doesn't work. So the key is we invest, we diversify, knowing that this is going to come, right? This happens all the time. There's always a time where it goes down. We just need to be ready for it. And the way we invest should be conservative in the sense that we need to be able to take the hit, right? The portfolio should be ready for you to be able to withstand a big loss and continue investing.
And just look at the difference between when it started dropping and when it recovered. How long? 2007 to 2013. It's almost 6 years. It's nothing. For a long-term investor, which is, in my definition, anything between 10 years plus. So a long-term.
The presentation made by Sebastian at Hub Impact should be seen together with this as very relevant. You said keep a buffer always. You see, what has happened is when I analyze all these crashes, I've seen a few of them in my 100 years. What happens is, you see, people get so taken by this hype, they think it's only going one way. They put everything in it, sell the home jewelry, sell all the savings, and they put it in the markets because they think it's only going up, up, and up. Those are the people, when you see, they are rich people. They were very rich. They were because many of them died. Many of them jumped from the top, and committed suicide, etc., etc. Intelligent people get into this hype. See, they get carried away.
It's very
So the
tempting.
important thing is to keep control both sides.
It's very tempting because when you invest in here, it's like it's going up, it's going up, it's going up. It's tempting to even go take a loan and say, over 5 years I can double my money. But that's what the market has done, right? In the past 5 years, that's definitely double. So there's a temptation to go borrow money at 5%, put it up there, and try to become rich quick. But the problem is then you leverage, you take risks.
Yeah.
And when that goes down, which
This-
it's going to
this what
happen,
happens,
it
yeah.
always happens. Then you're in a situation where you have to sell at a loss and basically lose everything. So the key is think long term. Know that you will become, you will be tempted to. Basically, this fear and greed, both of them are working all the time in your head. Right? You want to invest more because you want to gain more, and you want to be more aggressive because there's more to win. But at the same time, when things go down, it's very scary. So the key is diversified, balanced portfolio, different assets. Right? We talked about stocks. We mentioned bonds, and then the key is not to touch. Tony always gives us this example of the best individual investors, according to some studies, there's two kinds of them. Those that have forgotten their broker's account, so they haven't logged in for many years and they just made lots of money, and those who died, and the money is still there. These are the two kinds of investors that most often succeed. Just put the money in, don't touch it, right? Because we can't time the market.
Correct. And yeah, again, depending on your time horizon, try to balance your portfolio, bonds and stocks. In terms of bonds and stocks, so a rule of thumb is your age in bonds in percentage. So if you are 30 35 years old, always have 35% of your portfolio in bonds. That basically prevents you from losing money if this happens when you are 55 or let's say 60, because 60% of your portfolio is already in bonds and will suffer less volatility. Yeah, and review and rebalance your portfolio regularly. By regularly, we mean not too often, yeah. We mean once a year as a rule of thumb. Again, rebalancing and review happens if you are investing regularly. That happens just automatically, naturally. Some books I liked, and yeah, the Bogleheads Guide to Investing, definitely our way of doing things here. In the same vein, but a little bit more developed, is the Random Walk Down Wall Street. And nothing to do again with the stock markets, but if you really like economy, I know it's a subject that's not really exciting and fun to read. This is the best book I have ever seen, and it's a comics book. It's a comic book that that teaches you about the economy in a funny way, in a nice way. So buy it by no means, and my Bible, the 10-day MBA. Always have it on my desk. 10-day MBA. That's what it says. Just taking the MBA and crashing it into small modules.
And for someone who is looking to start investing, which book would you recommend?
To start investing, I mentioned Poor Dad, Rich Dad, but again, that's just some, for motivational purpose. You will read it and you will, But personally speaking, Random Walk Down Wall Street. But the Bogleheads guide is easier to read, and it's more to the point. I know here we like Andrew Hallam's book as well. But there are a lot of books out there. I mean, just you need to pick the right ones.
The Random Walk Down Wall Street basically explain that stock picking and active investment is just a waste of time.
Correct. So yeah, it's all about index investing and passive investing.
So Brighton studied a lot of the investors on Wall Street, and he realized after a while that, I think he takes the example of a chimpanzee and a monkey just throwing darts
Yeah.
and stock picking like this randomly, and outperforming the majority of active investors.
Correct.
And he's done a lot of studies based on that initial function hack, and he's been, I think, it's the 7th version, I think, of this book is now out, and he's been studying this for the past 40, 50 years, and since the beginning the message is the same. Stock picking, active investment, trying to time the market is just useless. It just doesn't work for the long term. You can't do it. And on aggregate, on average, everyone like you and me who's not willing to spend 10 hours a day for the whole week trying to understand the market, easiest is just to go passive.
Correct.
Because then you get the market returns with a lot less risks.
Yeah. And again, the book is a bit thick with a lot of practical information. So he literally gives you the phone number of Vanguard and what are the, So it's very, very practical. But the conclusion is, buy one fund and keep it for the rest of your life. So I read all of this just to tell me this. You should have told me that from the beginning. But actually, but it's just explaining to you why we get to that. It's very important to have that clarity and understanding of why does it work that way.
How about this one? The top 10 days and the what is it?
Oh, it's literally just business courses. If you want to learn about how companies work, if you are working like I have it on my desk. If I want to launch a marketing campaign,
It's not about the investment.
No. These two are not about money. It's more about like if you really like want to develop that knowledge. And they are easy reads, to the point, quite nice. All of you should, if you want to start investing, you should do this course. It's for free. And it's amazing. So you go through modules, and every module ends with a test, and you accumulate points. So the module is stocks, bonds, funds. You can skip all of these. You can just go to the mutual funds and learn about it. And it's practical. You can literally build your own portfolio after while you are going through the course. Because it's very very well done. My story ended this way. I really started questioning the ethics of the financial industry since I met those gentlemen from different financial institutions trying to sell me stuff. I found that a purpose in life is to join this group and also outside this group to teach people about personal finance and how not so complicated it is. In the process, the good thing about these things is like once you set up your portfolio, once you have that mentality and that process just working on its own, you suddenly have free time to do stuff, to do really things that matters. So obviously I found new hobbies and I wish I met these guys before I went through all of that hustle, but I was looking for like-minded people and people who are interested in personal finance. I found you guys on Meetup, and the beautiful thing is I found a whole new tribe called the Financial Independence. That's really nice, So that was the subject of one of our videos.
Is everybody familiar with the concept of financial independence and what that means to us? Who doesn't really know what that means? Do you wanna give a little bit of a...
Well, it's just like, again, as I said, the way I see it is a new tribe of people across the world trying to be financially independent and get out of the rat race. And the most important thing for me, because at the beginning everyone goes into this thinking about money, thinking about how, but actually once we speak about that, and again you set that fund and put it there, we end up having free time and we discuss about spirituality, about sport, about it's a group of people. Basically, I don't know if I described it properly, but I'm still literally I started listening to those podcasts from the Mind the Finest, fascinating people traveling all over the world, not clinging to things, not clinging to material things.
They're basically using those investment returns to fund their life, right? So you reach financial independence once you invest sufficiently that it covers the rest of your expenses. Typically you wait for the time to enjoy that time, but so these people that achieve financial independence, some of them just stop working much earlier and they're done with more important things in their life and they just live from the returns on the business. So that's what the discussion is about.
Another question,
Please.
maybe it's a bit personal. Like, you said that you started investing, so if I may ask, how long have you been investing? How many years?
Not too long. So this is perhaps my second year. I used to invest like real estate. I used to have stock options with my companies, but not. Sorry?
Passive investment, only 2 years.
Only 2 years.
And which bank do you recommend?
Well, there is a presentation that we have online about brokerage, all sorts of brokers, but I'm using Swiss Pro Others use Saxo Bank. So,
And during these 2 years, have you experienced any job
no, it was
or have you analyzed if your investment? So I mean, you have your investment is growing.
it is growing, and I was lucky to invest in, I don't know if it's the right time, but I know also I'm not, I don't have the illusion that one day or next year, 1 year will be less, or perhaps a crash, and I will lose, I remember once we had this debate when I said, you could set a stop loss mechanism to not lose your money, but and Sebastian correctly said, no, we don't do that. So I was like, that's weird. It's interesting. Why didn't do that? So I had to go back and check it out and understand the rationale behind it, and it's just the long term. Like if you are diversified enough, if your portfolio is balanced, it doesn't matter how much you lose. It doesn't matter. 50, 30% in 3, 4, 5, 6 years, you get back your money and you will grow 10% S&P 500 yearly since inception.
On average.
I really don't care if it's growing. I like checking my portfolio. Yeah, sometimes it's just compulsive. I know it's unhealthy. It's just like checking your email every second. So I check it, and I'm happy when I see green, and I am sad when it's red. But I know it's nothing. Yeah. Sure.
So when you say rebalance, do you mean like say you have stocks, bonds, and something else? Or just the two?
Well, we simplify it. We say
Okay, so
stocks and
what do you
bonds.
mean? Like if you have more stocks than bonds, you mean you equalize? Will you go back to having this, or no? You have the percentage of bonds that you say is safe for your bank?
Yeah.
How do you rebalance?
Well, basically, let's say, my age is 35. I have 35% of my portfolio in bonds and the rest in stocks. Next year, I will raise by 1% the proportion of bonds every year a little bit.
So you would just raise the bonds, you wouldn't lower the stocks, or?
What automatically happens, like
So you
one.
literally take stocks and buy bonds?
Yeah, you can take extra money that you have, your income, put it more in bonds.
And you cannot lose money with bonds.
No, it's safer. It's much, yeah.
Less risky.
Less risky.
So that's
You can default to this.
bonds fluctuate too, but they tend to be more stable, less return. So on a risk return, risk-adjusted return, it's lower, but it's much more stable. So it provides this stability to the portfolio. And rebalancing, as Brahim was saying, is about once a year. And typically, while you're contributing, it just means that you buy more of what you have less. Right? But if you're looking at a fixed amount of money that's invested, say today, 35% in bonds and 65% in stocks. If the market goes well, stocks will grow. Let's imagine 10%. Next year, it's your birthday. The stocks have grown from 65%. Now it's gone up 10%, so you will reach 70 or 73% maybe. But you want 36% in bonds, so you will sell stocks potentially, buy bonds, because bonds are now maybe at 30, around 30, and that is part of the mechanism that makes this approach sustainable even in downturns, because we end up buying stocks when they're low, right? If they lose value, they become cheaper. They also become a smaller part of your portfolio. And when you rebalance, you sell bonds that were basically your reserves, and you buy stocks at a discount, right? There's a lot of another risk is that you want to buy more of something cheaper. So basically, the trick is to stick to your plan, because when you build your plan, you know it's going to work in most situations. You stick to it, and you let it go.
Basically, it's more on financial goals. Actually, you should have your financial goals. When you are knowing like this is my financial objective, and I expect X amount of return every year, then you decide what sort of leverage you would like to have on bonds, equities, or commodities.
I like when people say,
Portfolio.
how much you want to make every year? Like, what's your target return? That's what an advisor will tell you. Determine your target return, and then we'll take enough risk for you to be able to get. Nobody can predict the future. But look, I know where you're coming from. We use this diversification, sorry, this balanced portfolio to manage risk mainly. Most of us are more scared of losing money than are motivated by making an extra percent a year. Right? Now, it is used as a compass. As Tuni explains, this is your guide. Right? You set your direction, you know that this is the where you want to go, and you know that this is how much risk you're willing to take in your specific case. And no matter what happens, even if the market takes you left and right, you come back and you take your direction and continue.
It's more on opportunity cost basically. Like you have an opportunity to invest on bond, you know you're gonna get X percentage of return without taking any sort of a risk. But yes, if I go on equity, what is that amount of a percentage that I'm willing to forego?
Right.
So basically on the opportunity, what is the risk amount of a risk that you would like to take and the amount of a return that you expect, you build up your portfolio, diversifying, not to taking too much of an exposure because your financial objective is 18% per annum. That's it. Work for it, achieve it, and move out of it.
You can look at it like this.
Could you suggest some ETFs for debt, for fixed income bonds, for example? Because straight bonds, there's a minimum 100,000, 200,000, nothing less than that. So could you give some examples of ETFs and bonds?
There's lots of ETFs with bonds. I think Andrew Hallam suggests a few of them depending on where you come from. Typically, all right, so bonds is a complex question. I think it's the topic of the whole presentation, but to answer simply, there's maybe a couple or three bonds ETF per country that would be suitable for this approach. So if you're looking to retire in a specific place, typically you want to have some security linked to that specific market in that specific currency. If you're considering your future in a way similar to mine, which is I don't really know where I'm going to live, and I'm willing to be flexible, then there's 2 or 3 bonds ETF that are suitable for my needs and that are just global bonds.
Direct bonds? You mean direct bonds?
No, ETFs.
ETF.
I buy them the same way as I buy stock ETF on the broker. The same way I would buy a stock, just representative of the bond market, specific index.
Like PIMCO? PIMCO total return?
Not the one in particular. I'm using either iShares or Vanguard ETFs in general, index ETFs, and they have a wide variety of bond ETFs.
I mean, when it comes to diversified bond funds, there are not so many differences, whether it's Vanguard or PIMCO, as long as they are diversified in the right way, and the costs and the fees are low. I don't see big difference. Sometimes you end up having three of these ETFs and they're all Apple to Apple.
Do you recommend taking a leverage and buying regular income fund? Leverage, you take a leverage and buy a regular income fund.
No.
Do you recommend that?
No. Meaning you borrow to buy stocks? That's not.
But generally there are some very well reputed income funds which is mostly invested in debt instruments and they give 6 to 7% on a pure vanilla product. When you take a leverage, you pay 2 to 3% leverage cost and make an additional 3% on the borrowed money as well. And I've seen the fluctuation in NAV is not that big. Is it recommended way of doing it or not?
In our approach, leveraging is not a good idea. If you want to take more risk, you go more into stocks. But we don't want to be investing money and risking money, even if it feels very safe. That is not ours. Because that's what leads to bankruptcy. That's the short pattern. Now, maybe there's specific cases where we could look at it, but in general, the recommendation is to not leverage.
Yeah, it's simplicity, like the approach is all about simple, all about less hassle, basically. But
less risk.
Yeah,
Less risk.
I hate debt. I know I shouldn't say that because there is health debt and not health debt. But borrowing to invest is not. I'm not what you think that personally.
it's against Boglehead philosophy as well. Guidance is never to borrow or leverage, mainly because the risk is not worth it. You can either increase your equity to get the high return. However, when you leverage, you run the risk of getting what's known as a margin call, which forces you to sell at the very bottom, and that's what gets a lot of people into trouble. So you always, you never risk more than what you have. With leverage, you can lose more than 100% of what you have, and that's not very good risk-wise.
And 7% yield on a bond is high risk bond, very high risk bond. And what is now called high yield, it used to be junk. Previously, it used to be categorized as junk bonds. So this is not risk-free; it's not very high risk.
So, sorry, can you help me to understand why wouldn't you want to buy bonds directly again?
It's a high ticket. So general value is $100,000.
Oh, okay, it's expensive. Right, okay.
Normally, in some jurisdictions in your own country, you should be able to do so.
Well, another thing is that if you buy bonds directly from, say, government bonds, it's going to be one country government bonds, where if you buy an ETF, you can also diversify. It's a fund which holds bonds from different countries, so you also diversify in that way. So there's nothing against it.
But it works.
It works by your
From the Bogleheads perspective, you can just hold your own country bonds and buy one of them, and that's still okay.
I just wanted to get back to on the rebalancing as well. What I have noticed in my past experience, as long as you are in the accommodation mode where you keep investing regularly, say every month or 3 months or whatever it is in your case, you don't really have to do the once a year rebalancing, because as you put the money in, you rebalance as you buy the shares. So if you decide to stick to 33% in bonds and 65% in stocks, you just adjust as you buy. And in my case, I didn't really have to sell one to buy the other in the past 3.5 years. But then I understand that depending on the market behavior, if it goes a little bit more extreme one way or the other, and in the case where you stop investing and start putting money in, that's where you will have to make this one date in a year when you rebalance.
And is there any advisable split between various asset classes like stocks, bonds, real estate, any other? Is there a good recommendation? Of course, it will change with the age, but so that every age group will have a different combination.
Bogleheads philosophy just recommends simple portfolios, and you can choose either a 2-fund portfolio, 3-fund portfolio, sometimes 4. Very simple. They're all described in the books. I'm sure should also provides a number of options, and they're very simple. The simplest one is just 2 funds, stocks, and Eurasian bonds, and that's it. And that is already 100 times better than not investing. And then, if you want to improve a little bit and add 5% to your thinking and try to improve things, then you can add an additional asset class, or start looking at how assets are allocated a little bit more. But the very basic is just a big chunk of stocks, Asian bonds, and you're already much better shape than most people that invest.
So in the book, it is some splits
Yes.
are available.
And it's explained, and some of them include gold, some of them include real estate, other asset classes. Really, those two cover most of the needs.
And remember again, every one of these funds have multiple stocks there. So you are literally holding a lot of things at the end of the day. If someone asks me, do you have a Apple stock? I say, yeah.
Yeah.
I have Microsoft.
Yeah. Samsung. Yeah. I just come up with the name of a big company that's in the stock market. We probably own them. And that is one trade, one purchase. You can buy the whole world. Right? There's some ETFs. There's total stock market around the world. There's thousands of companies there. All the largest companies in the world are in that one stock. In one trade, you diversify across the whole world. Similarly with bonds, you can buy one ETF that covers the whole developed countries, a wide variety of bonds, so maximum diversification. For bonds is not as important as for stocks, it's basically the same price.
one more question. So, what kind of importance you give to cash flow against, because if you want a financial independence, then to run your day-to-day life, you need cash flow as well. So if either your investment should give you dividend or your real estate should give you rent or something. So how much importance you give to positive cash flow against the net asset value increase?
We look at them as one thing.
Because if you have a long-term recession of 20 years, then your asset value is going down or very steady, but you don't have a cash flow to live on.
And sometimes cash flow goes down and asset goes up, asset valuation goes up. It's very, you cannot just, well, there are different ways of approaching it. Some people want to have money coming to the bank account every month or every quarter.
I'm one of them.
Right? Some other people are fine selling a little bit of, some of their shares as they go and as they need. Both approach work very well, and there's really it's more of a personal choice. I think there's been some studies, and it seems that if you don't focus on getting dividends out of the company over long periods of time, return tends to be high. But if you need that security of money coming to account, you can also set that up.
Yeah, and there is also the 4%.
Right, if you talk about financial independence, there's a whole, it's another discussion. We have a summary on the website if you're interested, how to calculate how much you need and how much you can then withdraw. It's very straightforward. Can you guys hear the question when the question comes from the back? We'll start.
Better to repeat, better if you can repeat the question.
I can repeat the question.
I just want to know, do you have your own ETFs and your wife has her own, or do you do it together?
We have each our own account.
So you recommend separate?
So the question is, do I have my own account and does my wife has her own account? The answer is yes. Do I recommend that?
Yes.
Doesn't really matter. I think in the UAE it's probably a good thing because there are a number of rules that prevent my wife from accessing my wealth if something happens to me. So we just keep it separate for now. It can be a bit complex, but we just talk and we agree on what we do and it's fine.
And then another question, sorry. Would you, like obviously you have your ETFs, would you do another version of savings, completely separate from an ETF?
So would you invest only in ETF or in ETFs indexing and all that and something else on the side?
Necessarily investing, maybe just
saving, yes.
A certain percentage on offshore accounts.
Yes. So it's flexible. In my case, we have savings outside of the UAE, and then majority goes in the stock market for our investment. But it's good to have a buffer somewhere else. In any case, we always recommend to have an emergency fund available. If anything was to happen, you lose your job, or there's an incident, you have to travel, or extra expenses. We recommend always 3 to 6 months of expense saved, and that you don't touch for investing, and you don't touch to buy the next car or the next TV, but it's just there in case there's a disaster.
I would personally, beyond 6 months of emergency fund, I would, just not let your money go. So put it in an ETF. But 6 months, emergency fund.
So it's 5:15. We have the room for another 45 minutes. Are you guys happy with the way we're doing the question and answers? What we'll make sure is that everybody hears the question or that we do the question. Also, if someone has a different opinion, so when we answer, it's our personal opinion. If you have a different view on this, just raise your hand. We'll also let you speak. We want this to be a group and where we all share with each other, not just coming from.
I would like to learn, absolutely. If you guys have tricks, tips, new stuff, chip in.
So we open to questions on previous slides. If it's a personal question on the specific case, then maybe it's better to keep it for after the meeting. But if something that is good for people, please ask a question. Sorry, you were raising your hand.
Yeah, so this might be a little bit of an off-the-wall question, but I'd like to hear your opinions, if you have any, on what you think of Bitcoin and cryptocurrencies. Do you see that as an opportunity or a threat to this approach to investing?
Yeah, I have a personal opinion obviously about it. I think there is a hype, and it's like tulips.
Tulip. Yes, it's a tulip. I agree, it's a tulip.
Yeah. So whenever there is a hype, be careful. For me, the cryptocurrency, if it's not supported or backed by financial institutions like central banks, I'm not versed in Bitcoin, obviously. It's just my opinion, what I understand. I'm not going to put my hand into that, at least not directly. I will let the ETF guys invest in it the way they, or a portion. They probably won't. But yeah, it's an exciting subject. I like it. I read about it. But as an investor, I'm not going to put my hand in that. Not now, at least.
But to raise money, it's a good way of raising money. I would like to raise some money, a few $100,000 by issuing ICOs, they're called, right? Initial coin offering. Instead of IPO, it's an ICO. People are offering it.
Right.
You can create your own coin.
Yeah, then I collect the money. I give you a token, a digital token.
Then you are a business, you are an entrepreneur, and that's different, if you do that. But as an investor, I'm not going to invest.
This is humor. This is just humor. This is humor. This is humor.
Just following up on the cryptocurrency, does it exist ETF cryptocurrency? Can you buy ETF which will have bitcoins in different blockchains?
I was reading that actually there was a fund who tried to set it up, but what's it called, the SEC didn't accept it. But then they said they would be open to review this application again in the next couple of years.
See, that's exactly what I was saying. If it's not backed by regulators and central banks, there's no guarantee basically for me in investing in that. There is one rule. I don't know if it's under your watch. You tell me if it's part of the Boglehead philosophy. They usually say don't gamble or don't trade with more than 5% of your money. So if you wanna do that with little money, play with it. It's an entertainment for you, but it's not an investment for you.
The Bogleheads do not recommend that. But it's accepted as a practice. Bogleheads are more, go with a simple approach, invest all of it there. You know it's going to work. Why risk 5% when you're expecting to make 5% in the long term? Losing this 5% just playing around is basically a risk to kill that expectation. But another aspect of Bogleheads is we're not here to trade currency. Cryptocurrency is essentially a currency, right? It's like saying I'm going to bet on the euro against the dollar, and I'm hoping that the euro is going to go up while the dollar goes down, and then I'm going to sell and make money on that. That's just speculation, and it's based on things that are moving up and down that don't create any intrinsic value. Right? Stocks actually bring value and grow, like we've seen, because they generate revenue, they produce services and products that people need. There's real value in increasing, the average level of life of humans on the planet, and so that's where growth comes from, is when there's value. Cryptocurrencies are just a medium of exchange. It's like saying I'm going to buy gold, which used to be a medium of exchange, or I'm going to buy the yen or the rupee and hope that it goes up versus my currency. So we look at this as trading, forex, the same way as, and we don't do forex.
Yeah, I got a question regarding the different trading platforms. So we know we've got Saxo, Internax, and Swiss. Yeah. So, what would you say? How would you compare them against each other? Or there's one that is easier for someone to begin with, or there's one that is cheaper, or what's your experience on it?
So there are 4 or 5 of them available to us express here, and as we were saying, there's a blog post on that, or a presentation from last year. Each of them have slightly different way of pricing things. Each of them have access to all the major stock exchanges around the world. You just want them to have access to the ETFs you want to buy, so that's the first thing I check. do I have access to the Vanguard World ETF in the currency I need? And most of them will have that, so it will be very easy to tick as a box. And then it's about understanding the pricing structure a little bit, just to know that you shouldn't be trading back and forth all the time, because that's how you lose money. How much the ongoing commission is for the maintenance fee, or the custody fee, and understanding that's good. And then it's just a matter of, I would say, being comfortable with the platform, because they all provide more or less the same, they all have similar costs. The structure might vary a little bit, and some of them might look like they're twice as expensive in terms of the trading fee, but these fees are things that are changing over time. It could be that in a couple of years they cut those fees in half, or they double here, they add a little custody here. But in general, those discount brokers are cheap, and really any of them should be good for you. There are sometimes constraints as to what nationality can open an account and what sort of paperwork they need for you to be able to open an account. But I would say it's more administrative type of barriers than really choosing the number one stockbroker at the moment. They're all fairly comparable. Long term, those small transactions cost won't matter much, especially if you invest only once a month or once a quarter. Amounts of charges significantly higher than that.
Could you take a show of hands or who's using what in this room?
Sure. Internax. That's 5. Saxo Bank. 6. What else we have? Swissquote. Yeah, that is one. And Demos, who's not here, also uses Swissquote. The Giro, which is European Dutch. Yeah.
And Interactive Brokers.
Interactive Brokers in the US. Yeah. Right. So we all, they're all sort of represented.
I discovered another one, Robin Hood. Inc. Arabia, the magazine, which is, the Inc. magazine, Arabia edition, they had a write-up on it. It has a valuation of 1.5 billion. So a 3-year startup and 0 fees. No fees.
It's US based, I think.
What's the name?
It's US based, so.
It's US based. This is only for information, no recommendation based. I'm not making any commission out of it.
What's the name of it? The difference also between
Robin Hood.
Platform
Sorry?
is the jurisdiction where your money is held. So that's important to know from a taxation perspective as well. So Swissquote, your money would be in Switzerland, I guess Saxo in Denmark.
Do we have any index funds in the Dubai financial market?
Yeah, there are
and do
two.
you recommend investing?
2 or 3.
Do you recommend investing here?
No recommendation. No recommendations. Only information.
Yeah.
So the question is
tracking
the UAE market,
Yeah.
or
UAE market.
something you can buy on the Dubai Stock Exchange?
No, UAE market.
UAE market, there are a few. Yes.
Probably are.
Not too many,
There's
but
more
there are a
mutual
few.
funds and ETFs than there are of actual individual stocks in the world, right? Or stock portfolios. So yes, probably. And would we recommend it? No. Unless you're Emirati and you wanna make a bet on your own country and link your own financial future to the future of the country. In general, I'd rather not invest in something that is linked to my income source. So, for example, if I was, say, in oil and gas, I wouldn't take a specific share in the oil and gas industry, because I wouldn't want both my employment and my investments to be tied to the same industry. But that we digress on this discussion.
I would like a little clarification. This was a very nice presentation, but a little bit not so clear. You continue to say ETF. Do you mean passive index tracker products versus active investments? This is what you mean? Or
Yes.
Because ETF is a product.
Yes.
There are iShares, there are Vanguard tracker index funds. So could you clarify this, please?
Yes.
Because I don't know Boglehead so much. I don't know.
So when we talk about ETF generally here in Bogleheads group, it would be an index,
Passive.
broad diversification. Because it's an index, typically it should be the fund that is basically tracking the index should be passively managed to minimize cost. Also because there's not much work to do really other than tracking the index. And so it should be low cost, diversified, index-based ETF that is basically the equivalent of the mutual fund who tracks that same index, right?
ETF is one product. There's iShares by Barclays, BlackRock.
Yes, you can find
Then there
ETFs,
is,
multiple
Vanguard.
ETFs that are tracking the same index,
Right.
owned by different fund houses. So Vanguard will have ETFs that are tracking the S&P 500, and so will iShare or BlackRock, and the others, Fidelity will have its own. And they may even have multiple because they have some variation.
So see, they have brand names. Now Spider,
Yes.
SPDR. SPDR is a brand of State Street.
Yes.
Right? And iShares is a brand of BlackRock.
Yes, correct.
It was originally Barclays, bought over by BlackRock. ETF is a generic term, many issuers. Of course, these are the three major issuers,
Yes.
Vanguard, State Street, Fidelity. Between them, I think they are the market.
That's right.
This
we
is
don't really
90% of the market is these three or four.
Correct.
Is there risk in those providers?
There is always a risk with everyone, but
Well, yeah, yes and no. There is the question of what do you actually own when you own an ETF through a broker, through one of those fund houses, because it's a bit of an abstract concept, right? That you own shares in a company. But I haven't gone through that, but I believe that the regulation is there in place to really, make you the owner of that particular piece of ownership of the company through this system. Right? That's it. And then if the mutual fund house goes bust, the data on who owns what, my understanding is it's independent from the actual successor figure of that firm itself. Similarly with the stockbroker, the stockbroker should be holding your assets in a way that if they go bust, you're still owner of those assets. They can't simply be transferred to another bank, another broker. What they can have access to is the cash. The cash is on their account. A lot of people are asking how much of my investment is backed by or guaranteed by the bank, right? In Europe, we talk a lot about the 100,000 euro number. Basically, if you have cash in the banks, and for me in Belgium, I have my savings in the bank account up to 100,000 euro. If something happens to the bank, the government will guarantee that. When you're investing through a stockbroker, that is true for the cash you hold there. But once you have invested it, it's not there anymore, and it's not for them to take. They just hold a registry that says you own that thing, and they can't touch that. You can't touch that.
So if I understand this correctly, if index investing or ETF investing is for the long term, so earlier when you talk about technical analysis and fundamental analysis, can we just ignore that completely and just invest it, treat it as a fixed deposit? Is that the ideology behind it?
the reason I made that difference just for you guys to understand where the background and where this
but
is coming from.
if ETFs and index investing is a basket of that is basing on diversification,
right.
we don't really need to do the technical analysis of fundamental. Yeah,
No.
okay. I just wanted to make sure that's okay.
So this analysis is used for people who are trading, or they're trying to find inefficiencies in the market, right? And then Brahim said that the approach is based on the belief that the market is efficient, and it's a simplification basically. But it means that we don't try to find inefficiencies in the market, and we just bet on the whole market going up over a long time.
Yeah.
So we're not trying to get
Up or down, yeah,
right.
exactly.
So
Okay.
that's from a technical analysis side. From the fundamental analysis side, the guys who are doing the work is the portfolio manager.
Yeah.
fund guys.
Yeah.
So that's why we don't get into it. They do the math, they
Right.
check the companies, they pick the stocks.
Okay.
And in the case of an index fund, the manager is a computer with just some admin guys. So this whole analysis stuff is simplified to the bare minimum, and that's why costs are low. And we're just trying to stick to the index.
Yeah.
In your experience, what chunks of cash would you be investing on a monthly basis to make it cost effective with any of those brokerage houses? Is it $500, $1,000, or how do you guys find it?
So there are two ways to answer your question. Basically, I invest whatever I don't spend. You know, like once I spend whatever is left, I invest it. On which interval, if you are doing ETF, I try to do it lump sum 1, 2, or 3 times a year, just to optimize the cost with the broker. Yeah, I don't know if that answers your question.
There's no one answer for this, because you could save money over a period of time and invest every 3 to 4 months or 6 months to minimize the cost of transaction. But at the same time, we know that the market tends to go up. So you have an interest in investing earlier. So it's really, you can do a few little back of the envelope type calculation to see how much you're willing to pay for a transaction, but don't wait a year to invest.
I don't know if this is will this perhaps be related to the last talk you presented, that calculator, you know, kind of like mapping out your it's like the expenses and you know how much you plan to invest, you know, 10,000, 20,000 euros per.
Yeah.
But I don't know if this would help, you know, you know, for example, you just have to go through an exercise of going through that calculator, depending on what your goals are, to decide, you know, what you need to invest in.
But typically, if you start with the, if you start investing every 3 months, in most cases, it's already very optimized. If you make a lot of money and you're going with large numbers every month, there's not a problem either. I did do those calculations at the very beginning when I was developing a strategy, and I tested monthly, every 2 months, 3 months, 4 months, 6 months, and every year, and how that would impact my total net worth after, say, 20 or 40 years of investing. So I did all of that calculation, and really the difference was mine. It was, I think I was up or down 0.1%, you know, between 6 months and 1 month, or 1 year and 2 months. It's a very, very small difference.
Just to answer that question, I've seen in some bloggers they recommend say the transaction fee, consider the transaction fee of your broker. For example, Internet is €25 per transaction. So your fee for a transaction should be 1% of what you're going to put in. So or less. It's recommended as low as possible. So the threshold would be 1%. 100% of 25 would be €2,500. So what you should do is, as a minimum, build up enough, about 10,000 dirham to have €2,500, and then transfer that amount. But again, if you make it 0.5%, which would be €5,000, it's better. But in our case, the philosophy is to keep the fees as low as possible and contribute regularly. So it's up to yourself.
Finding the balance there. Yeah, but it's nice to have this rule of thumb, say 1%, 0.5%.
Would the brokers accept it if you don't trade frequently and you just buy and hold? Would they accept that with the brokers? They do that.
Yeah. There is account maintenance fees, so
yeah, they find a way to make money.
Like
they find a way.
When you look at those 1% rule of thumb, it's according to remember the international transfer fees as well, because usually the brokers are outside of UAE and the international transfer fees are often quite large. If you don't spend on your rand, it could be €150. So just when you calculate it's 1%, you can go to that single transfer cost.
Is there usually a minimum amount that you need to invest in order to open one of these funds?
Most of the brokers require minimum, and that changes from broker to broker. I've seen the number $10,000. I don't know if someone has seen lower than that. I think $5,000.
That's the first investment, right?
For the initial transfer. But typically, you know, if the minimum you need is 5, and you say, oh guys, I have 4, can I open an account? They say yes. They'll ask you how often do you plan on investing, how much you can do per year. So they'll help you. But it's never an amount that's not. If you can't save $4,000, then yeah, there's no work to do it.
Another question. So you can. Sorry, have you got any recommendations on tax advice? When we speak to a lot of the local IFAs, it's all about trying to get money out of the UK, my instance, or so having already done that. Have you got any recommendations or decent local tax advice?
The truth is, we in this group, because there's so many people from different places, we haven't looked at taxes. The best, from my perspective, my best advice to you is contract your home country, find an advisor that's regulated back there and that has experience with expats. In the UAE, at the moment, we're not taxed on personal income. We're not taxed on capital gains or dividends. So locally, there's not much for you to learn. You need to find someone, ideally in your home country, or wherever you potentially where your money sits, and see if they have experience with expats.
It follows on from your question on the location of these brokerage companies, and is that the right location for you? I don't know the answer to that, so go and find out.
My take on this is first go, if you can, through a financial advisor, a fiduciary advisor, and he will point you to the right direction from that perspective. Because if you go straight and look for a tax advisor, he might not give you the right advice for your situation and your plans. So
It needs to be someone who knows the expat conditions and environment. But then if you pick a local advisor, make sure you pay for his time and only for that. That's
I'm puzzling over which currency to hold my investments in. From the UK, obviously I earn money in dirhams. Is it acceptable to mirror maybe investments in bonds and stocks in pounds and in dollars, say, or is that just getting a bit too complicated?
I heard a couple of opinions on that. So the simplicity opinion, which is hold it in one currency, the one that you are comfortable with, the one that's from your country perhaps. But also there is the other opinion, which is that diversifying in multiple currencies. I personally haven't held in dollars. All of it, right? And that's accepted, easy to transfer everywhere, easy to have. So yeah, it's but perhaps having some cash in different currencies, like for example your emergency fund, could be held temporarily in a couple of currencies. But that's my opinion.
Are you planning to retire back in the UK, or do you know where you?
Well, that's what I don't really know. You know, because yes, maybe in the long term, yeah, but in the shorter term, yeah, I just don't know.
I guess the general advice is if you don't know where you're going to retire, it's probably best idea to keep your money in US dollars. Since for two reasons, since we earn the dirham and it's fixed against the US, so you're not going to lose much in conversion. And also, most of the ETFs in the world, around the world, it has different trading currency, but the underlying currency is actually US dollars as well. So effectively, hence the recommendation is US dollars. But there was a question on Facebook where someone was, if you're thinking or you're very confident of going back to the UK to retire, a recommendation I've made in the past is to actually have an account in British pounds, but you can buy a world stock which is based in US dollars, but it trades in pounds. So what effectively does is that, regardless of what the pound does at the moment, up and down, what you put in your money from the dirham into the ETF is the same as in US dollars. But when you retire later on and you need to take money out, the money is all converted automatically from US dollars into your local currency at the end. So that saves you that way. But it's 6 of one, half a dozen others. But that's only if you are very confident you'll retire back in the UK. If you're not sure where you retire, simple advice is to keep in US dollar account.
Okay, I'm from Belgium, and I'm not sure whether I'll be in Europe or not in the future. I'm investing in dollars at the moment. The advice of holding bonds or so in your country currency is something that's quite common in our group. That is if you know if you're going there. And something that I'd like to add to what Tumi explained here is it doesn't really matter whether you invest if you've selected the index that you want to follow and the ETFs that you're going to buy, and if that ETF is offered and available in pounds, in dollars, in euros, it doesn't matter. It doesn't matter which of those currencies you're using to invest in that ETF. The value that it holds remains the same. You're going to be investing in the same companies in a similar way. We've had discussions around this before, whether to invest in dollars or in euro for a specific ETF, because when the euro and the dollars are moving separately, it looks like the fund is behaving differently, but really the underlying value is the same, and it's just varying because this currency exchange is changing. But that's it. The actual value, the actual growth is the same. So the currency which you invest, if you're looking at returns, it doesn't matter. Yes?
Yeah, the question is regarding the CFDs. I saw CFDs on one of your slides, and I got really confused because trying to buy equities, but CFD you're not really holding the. Can you explain the difference?
CFD,
What is
you mean
CFD?
that vocabulary thing?
Yeah.
No, what I'm trying to say is that the other philosophy, the philosophy of traders and active managers is complicated, and it involves all of those other securities that really we don't deal with. Half of that I don't know what it means, to be honest.
Yeah, so when I went onto the platform and I typed Nicene or whatever, I found what I was looking for as an ETF, and I saw there's two different color codes, and one was CFD, one was equity. I had no idea what CFD is. When I type online, but it says like you're not really holding any shares in the company, it's just a contract.
We don't want to go into
more equity.
Right.
So you're physically holding an equity in the company, whereas CFD not really.
It's a different product, and I don't know the details of it. But we don't need to go there. Really. It's just an additional product of futures and.
I think CFD is speculative.
It's more,
Yeah.
It is a cash for difference. CFD stands for cash for difference, which means on the day of the settlement, if it's, let's say, a monthly contract you have bought, at the end of the 1 month, there is a date of settlement. On that day, whatever the value is, you either make a profit or you make a loss, but it's settled on that date, and you roll it over if you wish, and you again get into the same cycle, but you never get any delivery. You don't get possession of the product, that the underlying asset that you are. It's a bet.
Right. It's a bet.
It's a bet.
Well, most of them are based on bets. It's fascinating, but as I said, I love reading about that stuff and all those mechanisms.
There are too many right now players in UAE, and they keep changing and they keep coming back. They never stop. They've been operating for the last 30 years, but I don't know under what regulation they are allowed to operate. They're still operating. CFD is like a casino. I mean, you're taking a bet. You don't get any product. You don't get any delivery. No possession of the asset, but they're still there.
You know, those difficult terminologies, like, so the philosophy of the group is more like, just let's do this simplicity things, which is like passive investment. The active passive investment, they have difficult terminology which confuses you, and so which misguides you. Even when you sign the contract, there are lots of terminology which you don't understand, and you sign up, and then at the end trouble starts.
Yeah,
So that's the whole point of amnesty.
You're right, yeah.
And I think here you were referring to what you can find on the brokerage account, right?
When you actually look for an ETF, it comes out to give you two options.
That's right.
One is EQ for equity and one is CFD. So
right, and we just go with EQ, and we just know CFD is something we don't want to touch. Right, so the brokers, those discount brokers, they're there because there's a big demand for trading. Right, there's a lot of people use those brokers to trade.
Admin kind of.
Yeah, and it gives you access to all the stocks. All the stock exchanges with a lot of different products and investment vehicles. The trading is a big. That's how they make money. Those brokers, right? So they'll, in a sense, we're not very good customers for those guys because we invest once a month, once every 3 months. What they want is people that get on there, put their money, and then buy and sell all the time because that's how they make money. So most of those platforms are not very friendly for Bogleheads. But once you find your way and you identify the ETF and you say, okay, this is equities, not CFD, you select them, you put in your preferred portfolio, and then you just buy them once every 3 months. That's it. The rest, you don't need to go into the details. They provide you with way too much information because they're interested in you trading.
Excuse me, guys. Thank you very much.
Thank you. Thanks.
Yes.
Sorry, this is slightly off topic, but we always hear statistics about how passive investment, like I think 60, 70, 80%, whatever, of active investors, or it can. So why do active investors still exist? If it's better to just generally to invest passively, why do they still try?
Because of greed.
Fees.
Fees is human nature. So, but also there are guys who really believe that they can beat the market. They think that they have information, they have technique, they have the ability. So, yeah. And again, it's a philosophy.
So is it just blind? Are they just blind to the fact that actually the opportunity costs?
There's a whole industry that makes money of other people's money. And for those people, they live in a world where it's not even a question of whether it works or not. It's been there for the past, ever since the stock market exists, there's been people doing that, advising others and managing their own investment to try to do better. And it's only recently that they started comparing themselves, only later that they started comparing themselves with indices that are basically telling them what the average is doing. And then it became a race, do better than the market. And the truth is, a lot of managers are actually beating the market every year. When I say every year, is every year some of them beat the market, and then the majority, or just a little bit above half of them, are under the market. Right? On average, they make the market. They are the market, like Andrew was explaining. And so, when you are in that environment and you see that this guy, you're like, oh, this guy knows something. Okay, trust. So in their environment, it's the truth that yes, you can beat the market. What we say is, over long term, nobody can. And if somebody can, you don't know who it is in advance. You won't be able to bet and choose the right manager that's going to do this consistently for the next, 40, 50 years. That's just we don't even work for a majority of people until they find something better. But
do you mind saying this on the microphone, please? I want to hear this because this is the detail. This is what I was waiting for. Yeah.
There's what we don't want to do is tell you guys this is where you should buy, and that's it. Because unless you understand what's behind, it's useless. And the next time something changes, you'll change it, right? It's really understanding philosophy. But there is a simple portfolio that would work for most people. So once you've learned all of this, something that works for most people is one ETF, total stock market, Vanguard, in dollars, bought on the London Stock Exchange. You put majority of your money there. Actually, if you have only that one, in most cases, if you're far from retirement, then that's perfect.
This is the global.
That's it.
Global, yeah?
Yes. One ETF, you own the world.
There is also the target retirement funds.
And I don't know if there are ETFs for that.
Really?
Not yet, not yet, no.
Yes, so Americans and British have access to Vanguard directly. Different question.
It adjusts itself as it goes on.
Yeah,
It's
so it
required
all
that it
depends.
never have to
Sorry. Yes. Some do. Yes, there's two types. Some of them, all of them have dividends.
What was the question, please?
Whether they pay dividends or not, the index funds and ETFs. So they all have dividends. It's just because a lot of companies just pay them to their investors. Some of those funds will reinvest the dividend, and so that continues growing, and they just buy more shares of whatever they were tracking already. Some of them will distribute them, and that's up to you to choose. And when you select ETF, it will be indicated whether you're going to get the money on your brokerage account or if it's going to be reinvested in your own seat.
And there are also those who are specifically designed to deliver a high level of dividends. So they would select only companies that pay high levels of dividends.
You see, dividends are taxed 33% in the US. So it's no use going for a dividend paying ETF then. It's better to have it rolled over, isn't it? You see, US based dividends are taxed at 33 and 1/3%. One third is paid as tax. So there's no point. Capital gain tax for a non-US citizen is free.
Well, it depends on
It's the other way around for the US. A US citizen does not pay this 33%, but pays the capital gain tax. Whereas a non-US citizen is the opposite.
Yeah, but it depends on the objective of everyone. Like if your objective is to get an income, so you go for the dividend paying ETFs. If your objective is capital gains over a long term, then you'd rather have funds or ETFs that recycle those dividends into.
But if it is a US-based ETF, you're paying 33% on the dividend.
If they pay, when they pay you the dividend, correct. But if they
If they are dividend paying, tax is deducted at source. It's a withholding tax.
Correct.
You can claim a refund, but then you have to sign so many documents which are verifiable facts you have to give them, and then wait a few years and get a refund.
I think you have to pay them anyway. It doesn't matter whether
Well, you
you
can
are.
also choose an ETF that's not based in the US.
Yes.
So avoid that trouble.
You don't have to pay that tax if it's on the London Stock Exchange. So if it's based in Ireland, you're talking about the VWRD. The dividend tax rate is not going to be the same for the fund.
Yeah.
So you're
If it
better
is-
off if you're a
Exactly.
non-US
Oh, yeah.
investor buying from the London Stock Exchange. Plus, I think on taxes there's also the inheritance tax, which applies if you're a non-US national, which is better that you're outside investing outside of the US stock exchange.
Inheritance tax is something entirely different.
But I'm saying from
This is
tax-
withholding tax, you see. This is taxed at source.
Correct.
So if you're buying on the Irish exchange,
You're not
Irish registered, Luxembourg registered,
You're not going to be paying.
then
this.
I'm only talking US registered.
Yeah.
The product is the product.
So these are some of the little details that can become confusing. It's minor, and I would say as you learn, it's fine to just pick one that you know will work, and then look at those details. And sometimes it takes 6 months, a year to really understand this, especially that specific issue. It's kind of a little complicated, and still today it's not fully clear to me. But go simple. Start simple, go simple, and then learn as you go. Just buy one thing once a month or once every 3 months.
I have a question that's maybe slightly out of the topic today. Because, Brian, you mentioned that you need to have 6 months emergency funds. Bonds is equal to your percentage of your age. But how do you balance your investments versus bonds, stock, and property in real estate? Is there like a rule where you have like 40% if you real estate and the rest is a mix of bonds and
Bogleheads don't have a specific rule as to whether real estate should be included in your portfolio or
allocation or a separate discussion. They just advise on, if you're investing in stock and bonds, this is what we suggest in terms of portfolio allocation, which is your aging bond, more or less, right? Now you can decide if your real estate is paid and you find it's very safe and nothing will happen to it, you could say, I'm going to consider this as part of my safer assets and maybe reduce my bond allocation. Some people do that. It's up to you and to the level of risk that you're willing to take and the confidence you have in real estate.
That's the way I do it myself. I consider my property as kind of safe and bond-like asset and put everything in stocks.
Wait, I have a question here that we'll come back to. Yeah, my question was just following up on the recommendations for the ETFs for the stocks. Is there a suitable alternative for a bond as well? That is total gold bond.
Yes.
Domiciled in Ireland.
Yes.
US.
Yes, there's 2 or 3 of those.
What are the
which one?
I share for the global ones because Vanguard in the UK only has British bonds, indices, ETFs.
Do you
I
need
wouldn't
USD?
recommend the one I have
Is it
because
USD? Are you looking for one in USD? Are you looking for the iShare in USD? I think it's IAAA.
IAAA?
Yeah, it's the global government bond in USD.
Short term.
Relatively short to medium term.
So, look, there's quite a variety of them, and there's no perfect answer and solution that works for everyone. Even in my case, I have 2 ETFs of bonds because I didn't know which one to pick. But any bond ETF that covers at least your country plus more maybe, it should be okay. As long as it's low cost and it's high rating bonds, government ideally, because you don't want exposure to corporate bonds or high yield bonds or junk bonds. You don't want to just go for the safest.
On real estate, I can share some information. There are REITs. REITs are like direct equities, but there are now ETFs. They have made ETFs now based on REITs.
Yes.
So you can expose yourself to real estate without the hassle of physically doing all the documentation or going through this indirect route, either direct REITs or ETF on REITs.
And if you own the global REITs, ETFs, which are also traded on the London Stock Exchange.
Is that one?
iShares, or I have one with Spider, and it owns property here in Dubai. So I can say I own property in Dubai. You know Index Tower? I think they have like half of it or something. So I own Index Tower. Once
you get to stay on the Wi-Fi.
I get an access card. And I can go to the pool.
By the way, for your information, for those who doesn't know, REITs stands for Real Estate
Investment Trust. Real Estate Investment Trust.
Those REITs, they invest in real estate across the world, residential, commercial.
So we have a question there?
Yeah, it was just about the emergency funds. The idea is to keep that, so whether it's 3 months or 6 months or whatever of your kind of expenses, the idea is to keep that in cash in a bank account, right? It's not to have it in an investment portfolio which you can then sell. It's to keep it directly as cash. Is that right?
Yes.
Cash or cash investment, like a
Or
CD,
there are liquid funds.
savings, or put it in a mattress.
No, there are
accessible.
and liquid
Important to
funds.
bear in mind that in the UAE,
Liquid funds would be.
if you get into a situation where you lose your job, your bank account could be frozen, so you actually wouldn't have access to that. So that's another aspect to keep in mind. It's supposed to be easily accessible, so you don't have to sell your stocks in case you get into any type of financial situation where you.
It's very important to be a buffer, because you see, otherwise we burn those deals. But then you need emergency fund. You can't sell it if you're making a loss. Yeah, that's why you need a buffer, so that you can ignore what's happening.
Guys, you're live on Facebook. Say hi. I'm gonna turn off this.